Welcome. My name is Geoff Dohrmann, CEO and founder of Institutional Real Estate. And today we are going to focus on our quarterly ODCE Fund Index update. We've been doing these now for a couple of years and usually attract a pretty good audience. So thank you for tuning in. We really appreciate it. Joining me and the person who's going to be presenting today is Garrett Zdolshek, who is the portfolio manager for the IDR ODCE Index funds and the Accordant ODCE Index fund for private wealth investor clients. So it's an interesting time that we're living in right now, and a lot of changes, a lot of things that are going on, particularly when it comes to what's going on within the ODCE funds. So again, thank you for tuning in. You can ask questions throughout the program by going down to the Q&A icon down at the bottom of your screen and just posing those questions. I'll be monitoring those and asking Garrett the questions as they go along. So, feel free to make this as participatory as you'd like. We're here really to answer your questions and make sure that the questions that you have about ODCE Index get answered. So please join in and have fun with this. We're also recording this. So if you are wanting to share this with other members of your firm or other people in the industry that you know, we'll be sending you a link as well as copies of the slides. So you don't have to sit there and scribble and take notes. We'll be sending you everything you need to really be able to make some sense out of what's going to be presented and to really give some time to think through and digest what we're going to be presenting. So with that, allow me to turn it over to Garrett. Garrett, the floor is yours.
Thanks, Jeff. Video is moving a little slow this morning or afternoon. So thanks for having me as always. Always look forward to this review. We always try to come up with a title to give some direction or thoughts on what we're hearing or talking a lot about. And I think what is normal is kind of a high level question that we keep hearing over and over, in terms of history, reversion to the mean. Just because the historical average is something, does that mean we should be looking at that going forward? Office, for context, the historical weightings in office is probably not what we're going to see in the future. So how should we be thinking about reversion to the mean? How should we be thinking about historical averages? So we'll touch on that in a number of different ways and a little bit of background. I will start as usual with a quick update on NCREIF reporting. So we added this given the recent conversion. I know I talk a lot about this, but I think it's important to really drill into what that means and how that's changed. As usual, we'll talk about the market overview, where our returns for not just ODCE, but relative to the broader market. Fundamentals, a little deeper dive into what's driving performance, what's over and underperforming. And then finally, capital flows, redemptions, Qs, the historical view of where we are in the cycle there. And as always, by the way, questions, please feel free to type in your questions. Happy to make this interactive. Happy to talk about virtually anything related to ODCE. So as you have questions, please feel free to bring them up with Jeff in the chat bar at the bottom. So ODCE today, 3,800 properties. Occupancy remains very strong, 91%. The arrows are year-over-year change. So very little really change in occupancy overall. Certainly by property types, they're a little different, but still very strong at the top line. No change in number of funds, 25 funds. And leverage is slightly down. This is one of the most recent times we've seen leverage kind of tick down a little bit. So again, I think it's also a function of value more than anything. From a sector lot less change by property type over the last year than we've seen over the last few years. Industrial is pretty flat, along with residential, a little less office, and that's largely a function of sales these days. Retail ticking up for the first time in a while, and then self-storage and other are broken out now with the new classifications. Again, from a geography standpoint, very little change year over year. Again, I think not a lot of value change. Values have stabilized, and so not as much change in sector or property type as we've seen over the last few years. We're kind of often asked to put in perspective. As I said, office peaked around 40% of the index. Today, it's 18% if you include life science. It's in the high or low double digits if you kind of take life science and medical office out of that. So the traditional office is around 15% or even slightly below. The self-storage is broken out. You can see that's inching up towards 5%. Less transaction volume there than we've historically seen, but again, I think we'll continue to see these trends with the alts, other self-storage increasing a bit more, industrial and residential likely kind of flattening out going forward.
Somebody's asking, will the slides be sent around by email after the call? As I mentioned earlier, when we opened, yes, we always do that for these. So you don't have to scribble and take notes. You're going to get a copy of the slides. You'll also have a link to the recording. So if you want to review and listen in or share this with other people, you'll be able to do it. Back to you, Garrett.
Great. Thanks, Jeff. Dramatic change, though, from sector exposure has been a dramatic change since 2019, kind of going into COVID. Industrial is up 18%, office is down 18%, retail is down 7%, to highlight a few of the biggest changes. Again, I think this will flatten out a bit here going forward, but it has been a very big secular change, and I think this is one place it's hard to look at historical averages and say that's the way it'll be going forward. So probably a pretty big change until we see demand drivers or return drivers change this any further. Subtypes. So NCREIF started breaking this out. We thought this was a pretty cool way of looking at things. NCREIF has broken out these sectors, the traditional sectors, in terms of industrial, residential, apartments, specifically apartments, office, central business district, etc. So I thought it's pretty interesting to look at how granular now you can see these bigger sectors, much less the smaller sectors, including alternatives. And we'll probably see these alternative sectors continue to grow. From a market update, so ODCE update performance, I think those who've watched this before know I like to keep it in perspective with the other asset classes. In particular, equities measured by the S&P 500, and also REITs in the public markets for against private real estate. If you look, and again, I think this is a big driver of secular demand in terms of capital coming back, in particular to the private real estate market. Equities continue their bullish run at all-time highs or near all-time highs on many of the public market indices. For the first time in quite a while, we're hearing many investors say to us, we're underweight real estate. We're starting that rebalance. We like, the entry point for private real estate. Can talk about which ways to access and where to access. But, I think we're seeing across the markets, whether it be, the big institutional U.S. pensions, foreign investors outside the U.S., private wealth capital. I think across the board, we're seeing more inflow than outflow now, at least at our firm level. And it's largely a value buy in that, values appear, good. I think especially relative to where the capital is coming from, which tends to be the public markets and equities, where, many investors are probably overweight again, given the value increases. That had us kind of thinking about long-term returns, the cycles, where are we today? Real estate is a diversifier historically. It is a non-correlated asset class, and I think we're seeing that in the good times and bad. Over the last 15 years, Odyssey is right kind of back to its annualized return of around 7%. It ran up. Obviously, it had 20% returns at one point, had negative returns. But every 15 to 20 years, we tend to see a cycle. And I think we're kind of right back into those long-term averages. Really, whether it's Odyssey or REITs, that 7 to 9% total return. Certainly, volatility has inched up a little bit in private, but not compared to the public markets. And then if you start looking at the correlation, very little correlation to public market performance, good or bad, just low correlation. And then the negative returns, right? I mentioned every 15 to 20 years, we see a cycle. Over the last 15 years, we've seen 8 quarters of negative return, and they tend to be very clustered. It's what we've seen in the last 2 cycles before that as well. Here's that fuller view of the cycles going back into the 1980s. I mentioned.
Question here before you get too far into it. Why is correlation with REITs negative? Would it be closer to 1 if we shift REIT returns by 1 or 2 quarters?
1 or 2 quarters has very little impact on REIT return correlations. I've seen all kinds of studies kind of saying, well, if we lag it by a year, look at annualized, or, there's a ton of different ways to look at it. I think the public markets tend to look a lot more forward, and Odyssey tends to look more backwards, in valuations. So, you can solve for creating more correlation, but the reality is, on any given day, public markets are going to trade very differently than private markets. And again, I think that's, if you looked at these returns from a public market view, you'd see a lot more up and down. The drawdowns tend to be bigger, and the upside tends to be bigger in the public markets. In the private, when we do see a cycle, it tends to be very, very clumped together, very consistent until a bottom is kind of identified. And in our view, one of the biggest kind of turning points are these inflection points of seeing a 1-year net return turn positive. So whenever we've seen the beginning of a 1-year return turning positive, it has historically indicated we are on the next, longer positive cycle of total return again. We've seen that now for the last 2 quarters. We've had positive trailing 1-year returns. Again, you tend to see the quarterly returns get much less negative and then turn positive as well. So I think we've seen about 4 quarters of positive total return. And again, that tends to be the beginning of the cycle. We'll talk a lot more about what that cycle looks like in history, but from a return standpoint, it's largely been income. Again, the great equalizer, certainly values and cap rate changes appreciation or depreciation, but the income, has remained relatively strong. It is what's contributing to the total return really over the last, few quarters and the 1 year. From a value change or a peak to trough drawdown, the 90s were longer. Believe it or not, as long as this cycle feels, a lot of people tell me this feels a lot longer than the GFC. really only a quarter or two longer than the GFC, but the drawdown was longer than the GFC, but not nearly as long as the 90s. But it was about half of what we saw with the GFC. Much more of a fundamental change in valuations. I would say probably more clarity on financial markets and more clarity on solvency. Obviously, the GFC was a large cash crunch, and everything changed dramatically across sectors. This has been more of a real estate cycle. And then on the other side, the recovery. So we're 4 quarters in or so to the value recovery, maybe. Again, I think they're all a little different, but they do rhyme. So this is looking a lot more like the 90s recovery than the GFC. Then probably see more slower, cap rate adjustments, which again will be less, focused on value. So we're going to be a lot more focused on NOI and fundamentals and driving income. Again, I think we're about 2.5% above the historical trough, largely really driven by income. From a fund performance standpoint, so underlying ODCE funds, looking at the top performer in any given quarter, the bottom performer, and then ODCE average. I kind of mentioned that what is normal, arguably ODCE is the normalized number, right? The average, and this is the weighted average. But we are seeing outliers, and we're tending to see more outliers to the negative than positive, if you will. So less overperformance and more underperformance. But again, it's an outlier. So I do think we're going to see and continue to see some of this more, one-off negative performance here and there. That's probably a good indication of the cycle coming to an end as well, in that I think many fund managers, many portfolio managers are looking to really set that value bottom into their portfolios, into their assets, really think about what's achievable and reset going into 2026. I think there's a question around, are outliers because they're using more strict valuation marks? I'm not really willing to say that per se. I think there's a lot of ways to look at it, and the biggest thing is looking at the data clearly. And I would argue that those that are kind of on the lower end of cap rates and the lower end of value adjustments historically are catching up a bit. So from a data perspective, I don't see a lot of data that can support that the value adjustments are just because someone's being more conservative and more aggressive. I think it's more of catching up to the market. Some funds took probably early views on where the market was going and adjusted values accordingly. Others wanted to see a little more data and a little more support for that and are now adjusting.
There's another question. What are your expectations for ODCE gross returns in third quarter 2025?
Yeah, that's a great question. I would say they're coming down a bit because of some of these outliers, that I think we may know of and may not know of. So I think, we're expecting something, and I tend to think more in the net world than the gross world, but I think there's a lot of moving pieces this quarter that make it a little harder to get to that number this quarter, especially debt mark to market. We'll talk more about that as well. But as we think about net, I think, 30 days ago, we were thinking a little over 1%. I think today we're thinking under 1%, especially when you start thinking about debt mark to market, which is, lowering rates is a positive for the industry overall and a positive for valuation, certainly. But in the very near term, there is some debt mark to market noise around that. And, it can be up to 25 basis points even, I think on average. So it could be a fairly meaningful, short-term number. Going back, Jeff, I think the question is, are these dots, the top performer and bottom performer, the same manager or fund? And the answer is no. It's just in any quarter, it's what was the bottom and what was the top performing fund. And it's very different, typically quarter over quarter. I mentioned volatility and long-term average again. The red line showing long-term average. We're actually right back to long-term average from a volatility standpoint in terms of that spread of best performing to worst performing fund. It's actually in the green line. It's slightly below average. First time it's really been below average since COVID. And then the blue line is property type divergence. So best performing property type versus worst performing property type is very much back into historical average as well. I pointed this out in the past, but if you look at the green line around 2008, 2009, the volatility or the dispersion of return between funds was very high during the financial crisis. But notice the blue line remained actually below long-term average. The performance was not driven by asset allocation, just having the right sector exposure. Performance was very much driven by the asset itself, the credit, the lease term, the income, those kind of things. In this last cycle, performance was virtually almost exclusively driven by asset allocation. If the portfolio had the right overweights to certain sectors like industrial and the right underweights to others like office, it was virtually impossible to not outperform. That trend is clearly, moving away again. It's clearly moving back towards asset selection, managing assets well, efficiently, and growing income. And again, I think that's another, very strong contributor to our view that, we are in this next part of the cycle. We'll see more asset level idiosyncratic, risk in terms of some of these write downs I mentioned. But that's going to be driven by the asset itself, not necessarily the sector.
Okay, well, we got a whole slew of questions coming in. How many funds that make up the ODCE Index have closed for liquidity? What is this as a percentage of the total? How bad is the liquidity crisis? And what are your thoughts on BlueRock attempting to convert their interval fund into a closed-end fund? Well, they're really not part of ODCE, so.
No. And look, we do. I guess the only place I'm not willing to go is name specific managers, whether they're ODCE funds or non-ODCE funds. Managers aren't here to defend themselves fairly, so I'm not going to talk about any particular group. But I think I can. I think a lot of this, Jeff, really comes down to the liquidity section and the second part of this. But maybe I'll just generally answer it here, and then we can show some proof points towards the end. I would say, definitions matter. So how many ODCE funds have closed for liquidity? By definition, none. You cannot be an ODCE fund if you are not open-ended and willing to take commitments on a quarterly basis and accepting redemptions on a quarterly basis. Now, I think the point here, though, and the real question is, when they get redemptions, are they paying out those redemptions, how much of a crisis is it? And the short answer is the funds have discretion to pay a little, a lot, or none. Most Odyssey funds are paying something every quarter, but they're not necessarily, paying it all. A couple funds have no redemption queues and have fully paid out. And then others are in various phases from, anywhere from a couple percent of their NAV to, probably closer to 50% of their NAV, asking for redemption. So it's very wide. It's very specific to funds. I would say, though, it is getting better. We'll talk more about that. I think, the liquidity crisis is not like this is not new, right? We saw liquidity challenges in the financial crisis. Really, if you look at it, all the funds made it through that liquidity crisis in Odyssey. Leverage matters. I think Odyssey is very transparent, and we have a very good view of liquidity in Odyssey. In the core plus space, though, we arguably see even less liquidity. Probably don't have great data around it, but with higher leverage, we are seeing core plus funds turn closed end. We are seeing core plus funds not pay anything for quite a long time as they deal with debt challenges and things like that. So I think we'll talk more about the liquidity in detail, but I don't think it's as severe and difficult as some think it is. We don't have any redemptions any longer at our funds. We've paid out, and I think that's a trend we'll continue to see. Maybe I'll continue to keep this moving, Jeff. From a value perspective, again, I think peak to trough, we saw office 40% peak to trough adjustment. That's continuing to wane significantly. And this is just value change. So this doesn't include income. This is just cost of the assets, if you will, on a gross basis. Office even is moderating pretty significantly. I think a lot of people feel like we've found the bottom or very close to the bottom in marking down office. Data would suggest that. I think the other interesting thing that stood out to me probably the most was look how close industrial return is to Odyssey. It's kind of office Odyssey and then industrial going right to left. Everything else is actually starting to perform a little bit better than industrial. Again, trend maybe, historical average, certainly not near what the history has been over the last few years for industrial. But I kind of put that a little bit in the, reversion in the mean bucket.
There is a question. It says, are there any apples to apples adjustments for funds who may have collateral objectives which may limit their strike zone, so to speak? Example, funds with costly labor requirements or mandates, those sorts of things. I'm not sure I understand the question, but I'm repeating it.
I think what this is getting at is like a responsible contractor policy, maybe, Jeff, for like union labor.
Mhm.
And, no, I don't think there are adjustments. I think from a fiduciary standpoint, all the funds and all the investors have a need to invest for return first and foremost, and then collateral benefits are just that, collateral. So we really don't see those types of adjustments.
Okay.
I think, I mentioned the wide volatility, and again, we continue to see that. And I think it's even a little underappreciated by sector how wide the returns can be, even by MSA. So as you look at the main property types, the range of return, again, all office at one point was negative, but we are starting to see, like in New York City, start to come back a lot faster and stronger. And especially maybe like even in New York City with the higher quality assets coming back faster and having some, wind behind them again. So again, that kind of recovery is certainly in place. It's just not going to be even across property type, across fund, or even across MSA.
Another question came in. Is there a specific subsector driving the 4.2% returns in the other categories? Are you able to delve a little bit deeper to the other bucket return drivers?
Yes, we can do that. Actually, I have a slide in that in a couple pages. Maybe we'll hit on that, Jeff. Probably could have put it in any one of these locations. So let me hit the bigger sectors first, and then we'll talk about what's driving other. I think this is a by count. So, not weighted by value, but again, I think we're seeing the number of write downs continue to go down, albeit more slowly, with some of the tariff impacts from 1Q and 2Q. But we do see again a very clear trend of more write ups now than write downs. By sector, again, seeing the same thing, continuing better clarity and valuations, even office. And so, I think the outlook looks a lot stronger from a value perspective, in that we've gotten to the right values. Contribution to return, actually back to residential. So residential is delivering the biggest impact at return. Part of it's the weighting, part of it's the return of it. And so we're seeing that continued drive of residential, industrial helping, even office and retail on a total return standpoint. All sectors contributed positively to total return, which again is another trend. Second quarter, we've seen that trend. From a tile perspective, I thought this was pretty interesting to see how the different sectors are moving around. We mentioned retail for quite a while was the best performer. Again, on a trailing kind of 1 and 2 year basis, retail is still very, very strong. We saw a bounce up and down, and I'll cover that next of what's driving that other in both perspectives. But then, I think what was very interesting to me was seeing industrial in blue, really the second worst performer this quarter. First time in a very, very long time industrial has been anywhere kind of near that. And again, this is total return. So another way to think about it, with income and total return contributor versus just a value contributor. Okay, so I mentioned other data centers certainly in the news a lot. There's very little data center exposure in ODCE, but what is there has been an extremely strong return. That is 23% 1 year trailing return. Again, a couple assets, but very, very good. Manufactured housing, another really strong sector, and I think cash flow provider specifically. And then third, I think to a lot of surprise, retail mall. And that's more of probably a function of just values being written down, in the pessimistic view of the sector. But what has survived, the strong malls, are actually getting stronger. So the alternative subtypes here are circled to give you a sense of, with the new classifications, retail mall is clearly in the retail subcategory, but you can see data center, manufactured housing are in that alt bucket. And then on the other side, one of the biggest detractors 2 quarters ago, office life science, that was a big detractor of return. And then even to some extent industrial life science, but there's very, very little exposure to that as well. Uh, with that, maybe I'll switch over to fundamentals and some of the drivers, starting with a macro view. So inflation continues to, on a whole trend down, but did tick up a bit here more recently. I think, the Fed is trying to weigh the dual mandate, the inflation, with the unemployment rate, which is also ticking up on the right. Although GDP numbers came out this morning, I saw, and those were stronger than expected. So I think a lot of kind of noise in these numbers in the short term, especially with tariffs and how they're impacting some of the measurements as well. Kind of coming back to what is that normal. I think the trends are probably a little more important than the kind of quarter over quarter overreactions. Interest rates, first Fed cut we've seen here in this easing cycle, creating a little bit of spread and hopefully between cap rates and certainly the Fed's fund rate, but also hopefully the Treasury. Treasury's been bouncing out around a lot as well because of that. I mentioned debt mark to market. In total, there's definitely going to be, I think, a debt mark to market negative impact on value this quarter. Although it's hard to really predict exactly how much. We saw the 10-year touch, I think, just below 4, and it's 4.18 or something today. So we'll see what that number ends up at. Cap rates really unchanged quarter over quarter. And again, I think office is a hard sector at the moment to exclusively look at cap rate with the TIs and the way NOIs can be impacted. This is very much a cap rate that is calculated off of data only and trailing fact. So huge TIs or huge vacancies can move this cap rate kind of disproportionately in the short term because it's just data. It's not looking out 3 or 4 years. The stabilized cap rates are 100 plus basis points higher. And again, that's more of an forward outlook that I would argue is a bit of a number we should probably be paying attention to a little more going forward right now. Little kind of interesting fact, declining interest rates have been the biggest driving force from a cap rate, movement standpoint. So 80% of the spread is from cap rates, or 87% of the cap rate spread expansion is typically from interest rates going up. In other words, it's not necessarily that cap rates move as much as interest rates move and create that historical cap rate spread to interest rates. I think we're going to see that very much play out in this cycle again. Cap rates have moved, but I think some more of that spread will come with if the Fed does make a few more cuts here. Mentioned the inflation number ticking up a bit. Again, I think this NOI number is a shorter term impact of TIs, leasing, even in industrial, a bit of the leasing cycle with tariffs certainly slowed down the leasing cycle for industrial. But if you look at the kind of correlation in history, inflation usually means more NOI growth. And as we look out over the next 2 to 3 years, we really do see that NOI growth kicking in again into that long-term average of around 3%, if not even a little higher, even closer to 4. So, as we look at performance, good basis, stronger NOIs going forward, that really sets a pretty good stage probably for core real estate returns going forward. Yep. And then, I mentioned occupancy. Still very strong in industrial, 96% though, versus the 98, 99%, which really just means 98% occupancy means it's an auction, not a functioning market. I think seeing it come down a little bit is healthy. I think it shows the supply caught up a bit. But with cost of construction, with those historical inflation numbers recently, the entry point again looks pretty good from a price per pound. Replacement cost is a really hard number to generalize, across markets, and there's not a lot of great data around it. But as we look, the more newer assets are certainly trading below replacement cost. And those will need to see some appreciation to justify new development. If you can buy below the cost of building, there's going to be a lot more buying until building picks up again. Office is certainly the outlier. You can see the trend down 82%. Anecdotally, we are hearing that is stabilizing. We are seeing more leases. We are seeing tenants certainly go towards the higher quality assets. But places like New York, we're actually seeing new buildings being built again. And then the cost of debt. The floating rate is down from a meaningfully high, close to 7%, down just under 6. But notice how little the total cost of debt. 75% of ODCE funds debt is fixed. It's staggered. And so, from the start of COVID, debt was around 4%. It's around 4.5% today. Even if we rolled this forward 4 years and we assume the floating rate stays above 6, the cost of debt would only go up about 50 basis points over the next 4 years as a reference point.
The question about, can you speak about your observations in the multifamily housing sector?
Yeah, I think, one from a housing perspective, the demand and the view that the affordability is, of owning a home is worse than ever. I think it's viewed as one of the safe havens for capital and return. The interesting thing is it's from a return standpoint tracked ODCE as a whole really closely. So it hasn't been really an outperformer, but I think the stability of cash flow, the fundamentals that point to the demand for housing going forward, and while there's been some probably near-term overbuilding, there's a real need and demand for it. So I don't think anyone's overly worried about there being an oversupply. It's just going to take a little bit to absorb it. So near term, maybe not as strong of pricing or as strong of NOI growth, but long term, virtually everyone you talk to feels really confident in owning multifamily right now.
Another question, what is the composition of data within ODCE today, of debt, pardon me? What percentage outstanding is variable rate? I think you answered that. It's about 25%, right?
Yeah, so 25% floating, 75% fixed. But again, we're only talking about 27% LTV as a whole. It's when you really think about it, it's not a one-for-one relationship. If you go from 25% LTV to 50% LTV, it's a dramatically different view on cash flows, and it's a dramatically different outcome as to how much fixed and floating moves, or sucks up your kind of gross cash flows. So I think this is a key piece to why the funds tend to be so much more stable and able to work through these cycles. It's really just that low LTV to start. And then a maturity standpoint, very staggered. yeah, typically this is what we see, anywhere from 10 to 15% rolling kind of per quarter, or I'm sorry, per year. Uh, and I would say, office is probably the one outlier again, where in prior cycles, given that low LTV, really didn't see any assets go back to the lender. In this cycle, I think as managers looked at, in some ways, if you had a little higher LTV in an office to start, if values are down 50+% in office, uh, you may just want to let some of those assets go. And if capital coming in isn't accretive to total return, you definitely don't want to invest it in your office building. So we certainly saw that this time.
So somebody's asked, what was the average LTV prior to it coming down? And then what was the average LTV for retail?
Well, so Jeff, I think average LTV, right? Is that a different question than loan to value across the index is 27%?
No,
Am I
what was it? Because you mentioned that it's come down. What was it? What did it come down from?
Oh, yeah, I think the peak was like 28%. So it's slightly down, from the peak. Let's see. It was about 28%. So it's not down 0.7% from the peak, I think. Going into the cycle was probably a little lower than 25. It was probably in the 23 to 24 range. So, move from 23 to 28 and starting to come back down a little bit. But again, it's very low overall by any measure.
And how about retail? How does that compare to the overall index?
Great question. I think it really depends how you look at it. So there's two levels typically of financings. The first is asset level financing, and typically you see things like apartment with a little higher LTV than average because it's cheaper, with Fannie and Freddie type of financings out there. You tend to use more financing in like apartments and then less financing in places maybe like industrial today. So if you look at the asset level, but then it's how do you apply the fund level leverage? I would say retail is right around market, if you will, around that 25% as a whole if you take a pro rata share of the fund level. And then apartments tends to be a little higher, and industrial tends to be just a little lower because it's the total returns were so good you didn't need to, lever it up.
Another person asked, is that balance reduction or gross asset value decline? I think you mentioned that earlier, that it really has more to do with recovery in gross asset value in terms of the decline in leverage as opposed to a reduction or pay down in leverage levels. Is that
Yeah,
correct?
that's right. I think that LTV coming down is just values going up a little bit, which is reducing the loan, LTV. And that's really why LTVs went up too, is as values went down, the loans to value just went up a little bit. Should we go to the last section, capital flows? I know we had a lot of questions about liquidity and talk a lot more about that. I think to start, I'm going the wrong way, sorry. Let's talk about acquisitions and dispositions. End of fourth quarter 2024, market was clearly opening up. I think the optimism was clear. I think the outlook was really clear. And then things like tariffs started getting introduced. And so 1Q, we saw transaction volume come down. Also, probably a little bit of a hangover of 4Q, a lot of transaction volume. We did see higher transaction volume in 2Q, but certainly felt there was a little bit of a constraint there as investors and sponsors try to get their hands around tariff impact and what that meant. I think it also dramatically pulled back any new acquisitions that were in process as really the market took a bit of a wait and see approach to what it meant. What was being sold though, I think, was assets that it was clear, investors or the owners were selling. So almost half of the dispositions last quarter were office. Again, as we looked at kind of values and where these sales took place, they were largely at, on average, especially they were at NAV. And it's not just looking back one quarter, that's looking back kind of 2 to 3 quarters to see if the marks, changed dramatically. Certainly saw some outliers, saw a couple that were meaningfully above NAV and then saw a couple that were meaningfully below NAV. So average should not be confused with, individual asset level because it was really all over the board if you look at the granular level.
I realize the focus of the webinar is on ODCE funds, but there's a question. Do you see more open-ended sector funds? And in the alternative space, alternative specific funds, do you expect to see more inflows into those versus traditional diversified ODCE type funds?
Yeah, it's a great question. I think we certainly saw a lot of industrial sector fund flow. I think from a residential standpoint, uh, it's been a mixed bag. And then what other sectors are we talking about, right? Certainly not office sector funds, certainly not retail sector funds. There's very few, if really any, that exist anymore in the open-ended space. And then I think you come to these alternative sectors. My take is there will always be a hot sector. There will always be something to compare that investors want to get a little more weight to. The question is what happens when those things come out of favor and how that impacts capital flow, which I would argue is lower. So then you have these core plus funds, and again, I think there's a lot less data around the core plus funds, but again, a mixed bag. I can name more core plus funds today that are locked up and not paying anything, and that are arguably even considering converting from open-ended to closed-end. Then I can name ODCE funds in those situations. So again, I think a 50% LTV is a very different scenario when you're trying to sell assets and create liquidity for investors than 25% LTV on average. So I guess ODCE has a lot more transparency. We know a lot more, but I think that also makes it a bigger lightning rod for comparison, which is fine. But I think we should put it all in perspective.
And then there's a couple more questions here, Garrett. One says, when do you think ODCE Fund will buy an office building again?
Great question. I would say the sentiment has turned from I'm not even thinking about if you talk to the PMs and the managers, it's starting to turn right. It was I'm not even considering office. I won't even look at well, I toured this office building. It was kind of interesting, but I still didn't see the return on capital that I would need to like really want to do that. So there is a bit of a sentiment shift. Although, I wouldn't say it's halfway up the steps. It's like I took a step and looked at a building. um, I do think eventually, right, the clarity around demand, the clarity around supply will allow people to kind of think about it a little harder. It really just comes down to what's the return of capital on that investment, and it seems to be getting more interesting. So I know that's not an answer. I can't predict the future, but I think they will buy office again. I just don't think it's 2025.
Yeah, well, as Yogi Berra said, it's hard to predict the future. It's hard to make predictions, especially about the future. Somebody asked, how about open-end core plus as opposed to traditional Odyssey? I think you just answered that. But there's another one. If most of dispositions are office, but with no apparent Odyssey buyers of office, who's buying? Families, value add funds? Who are the buyers?
Yeah, that's a great question. So I would say we've seen two prominent buckets: family office, who have kind of a bit of a user need and long term kind of unlevered view of return. And again, I think they're way less IRR driven and way more just value driven, like tripling money over 20 years is totally fine for them versus, needing a set IRR in the double digits. So I think a store of value, especially in some of the more, you know, attractive markets like a Miami or something like that, bigger markets where land values, matters a lot, like in New York as well. We've also seen the office only kind of REITs or owners, tend to own a lot of assets in their specific markets, and they tend to be probably more bullish on the sector for a lot of reasons, right? One, it's largely what they do. So we've seen a few deals where, Odyssey funds have said to their partners, like, there's a lease, buy us out, give us some value. We don't want to put more money in, but it's probably the right thing for the asset. So a number of those kind of situations where a JV partner that's also happens to be an office operator coming in, and buying out the other partner. And then lastly, I would say there is a disposition doesn't necessarily mean you got value for selling it. So there are more and more banks and lenders owning office these days for their loan value, right? You can also, we do see the term disposed of to the lender.
Yeah. We've got about 3 minutes, so we better.
All right, I'm going to go fast. Thanks, Jeff. Cash flows came down a little bit, I think, and this is net in the black line. Redemption payments also came down a little bit as a percent of Q. And as we dig into that, there's really kind of three main drivers of these redemptions moving. Investor impact. So those are new redemptions coming in, and they're also rescissions of existing. So through 2024, we saw a big impact because we saw rescissions outpacing new redemption requests. And then add that to the blue, which is payouts, basically. So distributions of to the redemption queue. Last 2 quarters, we saw new redemptions come in actually outpace rescissions again, which is why when we look at the net impact to Q in the black dot, it's coming down, but it really stalled here in 2Q because I think with tariffs, which was really very early in, it was April 2nd, right? So right after Q1 ended, we saw a lot of tariff impact. I think that really no one rescinded redemptions further from there largely, and then we saw some additional redemptions. So as we look at percentage and kind of coming back to that liquidity point of view, we're down to like 12% of redemption or 12% of NAV in the redemption queue. Vast majority of our funds are paying something every quarter. We're seeing this tick down. We saw a pause, but I think this is going to get better again going forward. So it is getting better. A couple of the funds have fully cleared their redemption queues. Again, putting them more on offense. So largely, I think this liquidity discussion is really an individual, fund discussion of who's managed liquidity better And there's always going to be some really poorly managed liquidity situations. But we're also seeing plenty that are just fine.
So one of the questions that came up is the redemption tick up concentrated in a few managers or index wide?
It was largely index wide. I don't think it was necessarily any, big redemptions at a single fund.
And why do you think rescissions have declined, especially versus GFC?
I think that it was just a reaction to tariffs of, again, not needing to make a decision today and pushing it down the road. So I think it was just uncertainty is never good for any market, and it's no different here. I think that tariff uncertainty, paused things for a while at the beginning of the year.
Well, this question is from Dennis Mons. He says, okay, Liberation Day, all right, tariffs, but are investors now scared that they cannot redeem in the future given recent past history?
No, I don't think so at all. I think, we're down from almost 20%, almost half of it has been redeemed. I think every quarter it's getting better. Again, there were billions of dollars of payments last quarter. It's just a few more investors put in as a reaction to tariffs. So, again, I think there's always going to be some near-term view and longer-term view. Look at the trend. It's coming down. I think it'll come down more in 3Q and 4Q. Secondaries are very active. Again, I think secondaries paused for a bit because of tariffs. So all the above was, in our view, more of a very near term, but it's still leading to, a much better outlook going forward.
And that was a question that came up about secondary pricing. How is that holding up? And are secondaries more focused on a smaller number of funds or across all funds?
So I think secondaries are pretty wide. See a lot of funds transacting from probably the quote unquote best funds, if you will, performance wise, recent performance, the spread is very, very low, a couple percent, to even some of the lower performing or less liquid funds we're still seeing secondaries. It's just a higher spread, higher premium for risk, right? So I think the market is very open. I don't think it's not open for any fund. We're seeing virtually every fund have a market for a trade if there's a willing buyer and seller. Maybe not every quarter, but we're certainly seeing them all transact at one point or another.
And what percentage of the Q did the index get paid out in quarter two? I mean, you've got a chart there, but it doesn't show precisely what it was.
Yeah, so 9%.
Okay. And then what's the secondary discount prospective investor is looking for today?
It depends on the name, and it's all over the board. I could tell you it's basically probably almost flat to zero, all the way into the double digits and beyond, depending on if it's an ODCE fund, a core plus fund, or whatever it might be. So it's super wide, and it's also super dependent on just willing buyers and sellers in a particular quarter.
And somebody says, have you seen more investors shift out of Odyssey funds into core infrastructure funds, which plays a similar role in the portfolio?
I think we have certainly seen capital move into the infrastructure space, whether that's core infrastructure, open-ended infrastructure, the role. I think some really interesting research is being done on historical performance, and what it looks like. But, there historically has not been a broad-based oddity like index infrastructure to make the asset allocation with where, you know uh, and buyers and sellers together.
Right. And that's related to the last question, which is secondary pricing linked to perception of fund marks taken.
That's a great question. I don't believe it is. You know, a lot of people talk about secondary pricing as a percent of discount to NAV. And it's, I kind of relate it to, well, why is that a reference point? Shouldn't we be talking about kind of cap rate or kind of value on the asset? And if you think about, like, should a core plus fund at 50% LTV be trading at anywhere near the same discount to a fund that has 25% LTV? It's a much different discount and asset pricing in the, you know, if you think about it, pre-leverage and post-leverage. So I don't necessarily, I think there's a lot of perception and view of value rather than analytics around it.
Okay. I'm sure we have more things that we could talk about, but we really need to bring this to a close. We're already over time. A couple of things to mention. One is we also do a quarterly NAREIT update. So if you're interested in the public markets, you might look for that. And then we're also started recently a quarterly update on NCREIF itself, talking about the work that's being done behind the scenes at NCREIF, which I think many of you would find interesting. And then coming up shortly, we're going to have a podcast on an article that was recently published or going to be published in the Journal of Portfolio Management, um, written by Mark Fitzgerald from Affinity, Phineas,
Phineas.
Jeff Fisher from NCREIF, and Homer Hoyt and Will McIntosh, who formerly headed up research at Phineas, talking about the changes in the composition of NCREIF. So you might find that pretty interesting. And we're also going to be publishing an article about that, abstracting from that particular Journal of Portfolio Management article. So stay tuned for all of that. Lots of good stuff coming up. Garrett, thanks so much. Really good session. We had probably a record number of questions, a lot of interaction from the audience. Thanks to all of you for tuning in, and we'll see you next quarter.
Thank you.